Hi, welcome back to Solution in YouTube channel. In today's video we will learn about average collection period, also called receivables collection period. The term average collection period refers to the amount of time it takes for a business to receive payments owed by its clients in terms of accounts receivable. Companies use the average collection period to make sure they have enough cash on hand to meet their financial obligations. The average collection period is an indicator of the effectiveness of a firm's accounts receivable management practices. A lower average collection period is generally more favorable than a higher one. A low average collection period indicates that the organization collects payments faster. But there is a downside to this, as it may mean that the company's credit terms are too strict. Customers who don't find their creditors' terms very friendly may choose to seek suppliers or service providers with more lenient payment terms. Accounts receivable is a business term used to describe money that entities owe to a company when they purchase goods and/or services. Companies normally make these sales to their customers on credit. Accounts receivable is listed on corporations' balance sheets as current assets and measures their liquidity. As such, they indicate their ability to pay off their short-term debts without the need to rely on additional cash flows. The average collection period is an accounting metric used to represent the average number of days between a credit sale date and the date when the purchaser remits payment. Businesses must be able to manage their average collection period to operate smoothly. Let's see how to calculate it. When calculating the average collection period for an entire year, 365 may be used as the number of days in 1 year for simplicity. The formula divides the average accounts receivable with credit sales and multiplies with number of days in a year. The average balance of accounts receivable is calculated by adding the opening balance in accounts receivable and ending balance in accounts receivable, then dividing the total by 2. Let's say a company has an average accounts receivable balance for the year of $25,200. The total net sales that the company recorded during this period was $252,000. We would use the following average collection period formula to calculate the period: $25,200 divided by $252,000 times 365 days. The average collection period, therefore, would be 36.5 days. This is not a bad figure, considering most companies collect within 30 days. Collecting its receivables in a relatively short and reasonable period of time gives the company time to pay off its obligations. Let's take another detailed example in which we will calculate and compare average collection period for two competitors. Adidas and Nike both are competitors in manufacturing and selling sports equipment. Let's assume Adidas has total sales revenue of $15 million. It has opening receivable balance of $2 million and closing receivable balance of $3 million. The average of which will be $2.5 million. Also assume that Nike has total sales revenue of $10 million. It has opening receivable balance of $1 million and closing receivable balance of $800,000. The average of which will be $900,000. Let's find out the average collection period for both using the formula. Adidas collect from its customers 60.83 days after the goods are sold. Nike collects from its customers 32.85 days after the sales. It is clear that Nike has a strict collection policy and Adidas has a lenient collection policy. It also tells us that Nike has fewer customers due to less flexibility in payments as compared to Adidas. This is quite alarming situation for Adidas because Nike has accounts receivable turnover of 11.11 times in a year, that is almost double the turnover of Adidas, that is just 6 times in a year. This means Adidas has to rely heavily on external financing for vendor payments. If you have understood the concept, give this video a like and subscribe for more lectures. If you don't understand anything related to this video, please ask us in comments. See you in our next lecture. Take care.